All right, let's get started. Fernando Martinelli, welcome to POV Crypto. Thanks for coming on.
Thank you. Thank you guys for having me.
Fernando, we've been chatting a lot back and forth about the potential of Balancer as a system. And so I wanted just to get you right onto POV Crypto so we could talk about it with a wider audience. So can you give a little bit of a background both on you and Balancer and how you came to be there?
Sure. So I'm a control and automation engineer with a master's in robotics and image processing. I've been an enthusiast of crypto since early 2013. I got involved with MakerDAO with their, I don't know if you guys know, but back then there was like a target price that was not $1. So I did some control theory things on that side of things. And that's how I got to meet the whole team early 2016 when they first met actually in Miami. And that's kind of interesting because it kind of circles back to the story of Balancer and how it's kind of related to MakerDAO or the team at MakerDAO. So yeah, that's me. And Balancer started as a project at Block Science, which is a firm that does R&D and research in complex systems. And we started as a project there and realized that Balancer had a very big potential, or we still believe in that potential, and that ended off as its new company. And we kind of talked to Nikolai, who I knew back then in 2016. He really liked the idea. He was looking for something like that to use as a user. And he actually got more and more excited as kind of time passed by. He then decided to be our pre-seed investor and also our chief architect for the first version. So he coded a lot. If you go on GitHub, all our code is open source. You're going to see that Nikolai kind of did most of the commits for our current code. Yeah, so that's kind of a bit of the background of Balancer. And also, we've been joined by the awesome Mike McDonald, known for his work on Maker.tools, MKR.tools. He's our CTO, so we're very well served in terms of technical skills, I think. Yeah.
So I definitely want to go into the beginnings of Balancer and MakerDAO and that relationship, because that's actually new to me. But before we go any further, we should probably explain what Balancer is and kind of what it means for the end user. So can you give us the lowdown, the 101?
Sure. So Balancer is an automated market making protocol, an AMM market making protocol. So you can create liquidity pools and people can trade within any pair of tokens in that liquidity pool. And the new thing about Balancer and what excites me the most is like the flexibility of it. So you can create a pool with any number of tokens. Now it's up to 8, but that's kind of a technical limitation. We were very conservative in this first version. But you can create any combination of different tokens with any weights that you want. So you can have a liquidity pool that exposes you 80% to WETH and 20% to DAI, for example. So it's a very broad and very, very flexible protocol. And we aim to be like a primitive for others to build on top of us. So Balancer is really like something at the base layer for others to use and build on top. And I guess this is going to be discussed a lot in the next minutes. Yeah.
Absolutely. So I think the right mental model that everyone should start with is start with Uniswap, but instead of having 2 tokens, have up to 8 tokens, or in theory, infinity tokens. And so where Balancer is 2 tokens balanced 1-to-1 in their value, Balancer is
Uniswap. Yeah.
Uniswap, right? And then Balancer is up to 8 tokens balanced in a different way, as according to different logic that the Balancer code allows you to operate in. Is there any clarifying points or anything you want to add to that?
Yeah, sure. So I think one of the understated nice features of Uniswap that people don't know a lot about, because like it's fixed at 50-50, is that it always rebalances your portfolio of those 2 tokens. So if you put ETH and DAI in a DAI Uniswap pool, you are sure to always have the same amount of dollar value in both those 2 tokens, right? So if ETH goes up by a lot, you're going to be selling it slowly as it goes up, or if it goes down, you're going to be buying more ETH with your DAI in order to keep that 50-50. Now, Balancer makes that kind of property more useful because it allows you to the number of tokens. So that's pretty much what an index fund is, right? I want to be exposed to 30% Apple stock, 70% Amazon stock, and that's always the case. And if Apple goes up, that index fund should sell Apple stock for Amazon. Yeah.
So real quick, for those for people who not really experienced with using Uniswap or any of these things outside of just maybe going through the .exchange URL and swapping a token, like how do you participate in Uniswap pools? And then how is that different with Balancer pools?
So yeah, I think the most important difference is the flexibility. So you can with Balancer, you can have any exposure you want, and that actually makes the protocol a bit more complex in terms of on the trader side, because you can have like two pools that are identical, the same weights, the same tokens, but they have different swap fees. And I forgot to mention that that's also configurable, so customizable. You can have a pool that has 80-20 ETH DAI, 0.1% fee. The other one is 0.5% fee. So the trader who's going to go from ETH to DAI, they will actually be the most rational if they use the liquidity of those two pools. And of course, the trader is not going to do all the math to use exactly the liquidity that they should to get the best return. We have like what we call the SOR, Smart Order Router, which does that. So that's kind of an important difference. Other than that, one nice thing that Balancer allows you to do is to invest liquidity in a pool only by providing one of the tokens within that pool. Kind of as the DeFi Zap logic of like investing in a pool with one asset only, one click. But DeFi Zap is even better because they kind of wrap lots of transactions into one and make it much easier. Yeah.
You're muted.
Let's go through the scenario of comparing and contrasting Uniswap a little bit further. So Uniswap has 0.3% and it's a 50-50% balance of two tokens. Balancer, you could in theory have the same exact thing. You could have 0.3% and a 50-50 balance. But why? Maybe let's talk about like what happens when we start to adjust the balances between two tokens at like 75% and 25%. Why would somebody do this? And why, and how does this impact traders? And what's the advantage there?
Sure. So imagine you're a project that has lots of tokens of your own project in your fund, and you want to provide liquidity for your project tokens. Like you're probably not going to have as much value in ETH as you do in your own project tokens. They're illiquid. If you wanted to dump like all the supply you have, you would crash the price. So what you can do is you can create exactly what you said, a pool that has a lot more weight on your token side and a lot less in ETH. So you can provide that pool, that liquidity of, instead of say, if you had $500,000 in ETH with Uniswap, you would be able to provide to have like $1 million of liquidity. With Balancer, you can do like the 500K you have in ETH and 4.5 million in your project token. So it's it's a much bigger pool, and that bigger liquidity is more like is going to offer much better slippage for traders than a $1 million liquidity would on Uniswap. That's of course, it's a very simplistic comparison, but I think that's kind of your question, if I'm not mistaken, David. Yeah.
You don't want to talk, Christian?
Not unless you want to change subjects.
No, I'm not going to change subjects completely, but I'm going to change go on to a different riff. Yeah. Mm-hmm.
Yeah, it's fine.
Okay. Again, we cut this stuff out, except on YouTube. The thing that really got me excited about Balancer and the thing that really woke me up to it was Chris Bernitzky's tweet calling it an inverse ETF. It flips the rules of an ETF on its head. And so an ETF is an exchange traded fund, and there are fees with ETFs. And these fees have been trending down. They've been trending down towards zero fee ETFs. And these ETFs are just financial tools that allow people to get exposure to a basket of things. But Balancer really flips this on its head, and it allows not an ETF that charges you fees, but an ETF that pays you fees. Can you talk about that inversion?
Sure. Yeah. So you kind of pretty much explained it very well already, but the idea of Balancer keeping the values in a pool at their set out proportions, or the proportions that the pool creator wanted, which are the weights, is that it actually lets people buy a token when Balancer needs to sell a token to kind of get it back to the percentage that you should be at. So when you sell a token that someone wants to buy, you're actually charging the fee for that person to buy the token, because they're taking the active action of buying it, not you going to the market and selling the token. So that's pretty mind blowing to me. So you actually get rewards for giving the liquidity for the market to do what you want the market to do, which is rebalance your ETF or your index fund or your Balancer pool. Right.
So I guess why would someone want to buy a Balancer token instead of some other index option? This is not the only, there's sets, there's centralized options. Why if you want to go 50-50, you can buy Uniswap pool tokens. Why would someone go for Balancer?
Yeah, so definitely there's trade-offs. Set protocol, is that what you meant with sets, Christian?
Yeah.
Yeah, right. So set protocol has this very nice idea of letting people create their own strategies, and you can just follow, tag on to their strategies. So of course there's different products and protocols, but Balancer is kind of a more pure approach to having a very flexible index fund, and that allows you to have some exposure that you want to control. And Balancer earns fees, as we just mentioned, and with the idea of smart pools, that's something we can discuss in more detail, in the next minutes. But the idea is that you can do crazy things with your Balancer pool by updating the weights, by updating the swap fees, by doing by changing its parameters, so you can get more exposure on ETH if the the MACL, the EMA, whatever crosses, and you can kind of emulate a little bit of sets strategies. And the nice thing, one kind of difference that I like about Balancer compared to set, and again, those are all trade-offs, none of the protocols is better than the other, is that for set you need an auction that lasts 6 hours. So if you're kind of auctioning off $1 million of DAI, or as sets get big, it could be even more than that, you need that, a lot of people buying in that window of 6 hours. Balancer is continuous, so it kind of offers the liquidity for people to buy, and that happens over time. There's no time window, and you could control that time window if you wanted to change exposure. Let's say your pool has 20% ETH, you want to go to 40%, you want that to happen in 10 days. So you let people slowly kind of poke the contract and make the contract go to that higher exposure of ETH. That's kind of the concept of smart pools we can get into in a bit.
I think before we go there, there's a question I have on liquidity that I want to address. The whole idea of Balancer is these are liquidity mechanisms. Every Balancer pool is this liquidity pool. But if you go to the current set of Balancer pools, they're basically variations on the same 4 or 5 tokens, and that's just a limitation of Ethereum, right? There just aren't that many tokens available today. But there's a finite amount of liquidity out there, and with Balancer, on Uniswap, there's the ETH to MKR pool, and that's 50-50, and then there's also the ETH to DAI pool, and that's 50-50. And so when I see all these Balancer pools that, you can either theorize or come out with, there's 25% MKR, 25% DAI, and then 50% ETH. And then that's one pool. And then there's, a separate Balancer pool with a different balance of, some or all of those same tokens. And then there's a third and fourth and fifth pool with some of those tokens. And it seems to be, it's actually fractionalizing or fracturing liquidity, not actually making it converge. And so and you guys are brand new. You guys are just a couple weeks old, and so they were at the very beginning stages. But where do you see this as a problem of the fractionalizing of liquidity rather than the centralizing of liquidity?
Yeah, so we have always this this ethos of being an enabler, so being a tool. So we believe that the market will self-regulate to making liquidity coalesce around the most popular or the pools that found the best product market fit. One reason why we believe this is not going to happen, like you're going to have like thousands of pools, very small ones, is that if you have already a pool that's big, it's seen by all the aggregators, all the integrators. It's going to be chosen by the smart order routing algorithm. So the smart order routing algorithm is not going to choose 1,000 pools, because for each pool you interact with, you trade with, you spend some gas, right? So you have to keep like, you have to just get the 5 biggest ones. So those biggest ones in a pair will always be like, chosen more often and will be more profitable. So if you have like the same pool with the same distribution that you want to invest, a very small one, a big one, of course you're going to go for the big one, because the big one is getting all the retail trades and therefore generating more APR, right? So this is kind of a self-correcting mechanism for liquidity not to be fragmented too much.
You mentioned the smart order routing. Is that for between pools or inside of a single pool? Does the smart order router leverage multiple different pools to make an exchange happen? Oh,
yeah,
that's cool.
That's correct. Yeah, so it takes all the pools that exist that have been deployed using our factory. So again, just to kind of get back to the trustlessness, and we can talk about that again, but we allow anyone to create any pool they want, as long as there's ERC20 tokens in that pool. We are totally permissionless, so anyone can create a pool they want. And so as soon as that pool is created with our factory, we know that it exists. And SOR will take that pool into account for like getting the best return. So just a simple example, if you have a pool that has 90%, so 90% of the liquidity in a pair, and the other pool has 10%, as a smaller one, you want to trade 100 DAI. So let's say the pair is DAI ETH. 90 DAI will go to that pool that has 90% of the liquidity and 10%. So it's kind of obvious. So that both go to the same price. As soon as you get all the pools you interact with to the same price, you can prove mathematically that you did the best trade possible, right?
Who can create a pool right now? I know that you have public and private pools.
Yeah. So should I kind of expand a bit more on the differences?
Yeah. So why don't you explain what is a public and private pool, and then who can create each?
Wait.
Sure.
So let's talk about let's do one thing first. Let's talk about really awesome pool ideas, like concepts for pool ideas, and then let's talk about let's go into stuff like that, like the censorship resistance, privacy risk side of that. And so let's bundle that together. How's that sound, Christian? You're muted.
I understand what's the difference between a public and private pool, and who can create one of each. Like, I mean,
yeah, so that'll fit right into the same conversation as censorship resistance and all that stuff.
Or it could fit into how these things, what are the cool ideas and who can act on them, right?
Okay, I can quickly answer that, and then we can jump onto that. So yeah, so there's 2 types of pools on Balancer: the finalized ones and the private ones. So the private ones are actually a state before you finalize a pool. So every pool you create starts as a private pool. So you can add tokens, only the owner can do those things. You can, as the owner, you can set the swap fee, you can do whatever you want. Once you want other people to be able to provide liquidity to that pool as well, you make it like you finalize the pool. So it becomes a finalized or shared pool, like the way we call it on our UI. So anyone can provide liquidity to that pool, knowing that all of its parameters are set for life. So they know that the creator cannot add a shit token that they own 100% of the supply and drain all the other assets, right? So the finalized pool is that pool where there's no chances of changing any of the parameters. And the private pool is only you providing liquidity. Now, the nice twist about the private pool is that the owner, the creator of a pool, can be a smart contract as well. It doesn't need to be an EOA, an externally owned address, right? So if a smart contract creates a pool, it can never finalize. So it never finalizes the pool so that it can still change swap fee, can add tokens, change weights, but it implements kind of an interface that accepts external liquidity. So you send the controller address, you send some ETH and say, I want to invest in your pool, so that the controller passes it down to the pool and mints its own ERC20 saying you own 80% of the pool that I own. So the controller is kind of a gateway, and that can be a DAO. And we have examples of that, and we can talk more about interesting ideas of how that can work. But you make the pool a living thing. It can change its parameters at any time according to some well-known logic that's implemented by the controller of that pool. Does that make sense, Kristen and David?
Gotcha. So there can be a DAO that controls a private pool and kind of operates its own thing, or if it becomes a public pool on Balancer, it's kind of like locked in place.
Correct. Anyone can provide liquidity, and there's no need for a controller that's a smart contract. No, the pool is already finalized. You know that it's not going to change.
And that's in contrast to Uniswap, right? Where Uniswap day one, it is a finalized pool. And then Balancer, right, you could have a finalized pool on day one, or you could also have a pool that is still having some sort of influencer code. If whoever the Balancer exchange Balancer pool issued that pool, they don't have to give up rights to control for it immediately, and or ever, to whatever degree that they need to have control over that. But correct me if I'm wrong, all pools can eventually become finalized pools, right?
Perfect. Yes, that's correct. It's a one-way street, so you can only finalize it once and never go back. Yeah, that's correct.
Everything can always go more decentralized, more permissionless. Right.
Exactly. Yeah.
So when you guys are on your lunch breaks at Balancer on chat, what do you guys hypothesize or think about when you daydream about the future of Balancer pools? What are some really cool Balancer pools that you guys have thought of?
There's a lot of cool ideas that actually people have come to us with those ideas. We haven't really come up with them. So we can talk about your idea with Realty. We can talk about, like, for example, dynamic fees. So you know that in times of volatility, you can charge a higher fee for people to trade because liquidity is very precious in those moments. Like, say, Black Thursday, you could have charged like 3% in a trade, right? 5%. I would still have exchange with you, right? So you can create a smart pool. So smart pools are pools like private pools. They can be changed, but the controller is a smart contract that has some logic implemented that you can read the code and know, well, that smart pool can only change the swap fee. You cannot do anything else. Like, my money is safe. I know that all it can do is change the swap fee. And I can even know the rules, like if there's more volatility, then it goes up, or down if it has less volatility. So you can have that. One nice idea.
Sticking on that point for a second,
sure.
I think that is an insanely cool little gadget that you could incorporate. I think maybe people's first gut reactions are like, okay, you increase the fees on me during times of high volatility. Like, damn, you're trying to really extract your value. But I think people are missing the other side of that coin, where a pool that is in an automated fashion returns the most amount of revenue and fees for people that supply liquidity is inherently more liquid. And if you were trading on Uniswap on Black Thursday, you got gouged by slippage fees. And so I think that's a pretty clever solution to help in times where liquidity is in high demand, to really incentivize that liquidity to be there.
Exactly. Yeah, it's like, it's a market like optimization pattern, right? Uber does that, and that's why it's so successful. So yeah, I agree. That's a very cool idea. Yeah, you can have, like, imagine synthetic tokens like UMA. We're working with them on that idea. Like, imagine you have gold tokens that expire like in June and in July and all the months. One of the big kind of pain points of synthetic tokens is that expiry date makes them very hard to become liquid, right? And you can only like have exposure to that expiry date. People like to have exposure to gold indefinitely, right? So what Balancer can do is it can have a pool with different expiry dates. So gold June, gold July, gold August. And you can set, like the controller can set the weights of the tokens that are close to expiry to go down, and then eventually be removed from the pool and introduce a newer token in its place. So you always have like this rolling gold synthetic pool. So you own like the Balancer pool token, you know that you own exposure to gold permanently. So, and then other nice kind of side effect of that is that you made, all of a sudden, you created a venue for all those different months to be traded in a very liquid way, right? So it's both like a rolling synthetic that is a perpetual, and also like a pool where you can trade any of the months, like people want to have more exposure to June or August, they can meet in that pool. Yeah. There's like other ideas as well. If you want me to go on, I think there's like other cool ones.
So what do you think is the biggest constraint here? I see that in terms of like, I'm personally a little bit of an Ethereum skeptic. I'm skeptical of on non-native assets on Ethereum because I think that that's an attack factor. I am skeptical that native assets will actually have value. I think that there's very few native assets that have any promise today, and not sure how that becomes. Like, what do you like? Is it on the asset side? Like, what do you think are the biggest things that are preventing Balancer, Uniswap, and maybe even Ethereum from kind of continuing to grow?
I'm a big Ethereum fan and believer. So I think like a revolution takes time, right? So it's not to be expected that we'll have like shares that are tokenized, and Wall Street will move on to Ethereum in 5 years or like even 10 years, right? So I think we mainly need the like if 2.0 with scalability, and we need time. We just need time for enough teams to experiment on crazy things, and that's happening already. So I do believe in a future where everything is tokenized. Like if you deal with conventional world like share or stock markets, you see how badly done they are. Like they stop at 6 p.m. and you can trade on the weekends. And there's so many inefficiencies that are ripe for disruption with Ethereum. So I think it's scalability and time for people to experiment and prove that it can be done in a better way than in the way that's been done for the last 50 years, pretty much. Does that answer your question, Chris?
How would you characterize the state of assets on Ethereum today?
I think they've done great progress, and I think they are still MVPs. So yeah, I think Realty, for example, is a great example of something that can be done like on Ethereum, connecting to the real world. So I see like other projects like UMA and Open, like synthetic projects that connect real world assets to Ethereum. And I think yeah, there's like some limitations to liquidation processes, and yeah, the problem that happened with MakerDAO. So you cannot really rely on liquidation mechanisms 100% if you depend on external actors. And that's actually one nice thing of Balancer. We don't require any external connection, Oracle feeds or anything external. We're kind of self-contained, so we don't have that attack vector. But I think it's progressing very fast, Christian.
Let's go into risks and attack vectors a little bit more. Balancer is the ultimate version of Balancer is just like Uniswap, where it's fully decentralized, fully permissionless, but it's also way more complex than Uniswap. Can you kind of compare and contrast just the risks that you would expect from the finalized Balancer pools in comparison to Uniswap? And then we'll also talk about the other types of pools as well.
Sure. So I think that's actually the other way around. So the end vision of Balancer is not going to be possible to be as permissionless and trustless like Uniswap. Balancer today is completely trustless and permissionless. There's no admin key. There's no way we can censor any pool creation. There's no upgradability. So when we come up with V2, we're going to have to like entice people to migrate their liquidity. So yeah, I think there's some cool features we're already thinking about for V2 that will require some minimized level of governance, like some key like parameters that have to be set. And for that, we envision a governance and eventually decentralizing the project so that you have token holders. And that's another subject we can talk about. Token holders decide the direction of the project and the parameters of the project, if that makes sense.
All right, you got a question, Christian?
Yeah, I guess with that thought, we interviewed Paulo Arduino, the CTO of Bitfinex and Tether, and he's kind of talking about how Bitfinex, obviously it resembles kind of a geographically distributed company today, but it's definitely like a new type of company that's enabled by cryptocurrency, and it's continuing to evolve in different directions. Why do you think building like a DAO and governance system on Ethereum as like a blockchain and a project directly on the blockchain is superior to having kind of like a nebulous new age company, running this type of a thing?
Transparency and accountability. You can see everything on chain. Like you have a vote to change a parameter. You know that person that owns 20% of the shares of a project have voted for that proposal because they could sign that vote with their private key. So it's 100% transparent. And one of the big critiques of Bitfinex is exactly their lack of transparency, right? So I think that's probably my answer to that.
Is it really transparent? Like, can you tell me that Maker doesn't have backroom conversations about stuff? Can you tell me that in the future that this, backroom conversations won't happen, especially if it's a smaller group of people that are operating this thing?
That's another level of transparency. So there's like one level, which is like those people who own the shares have voted and said they want this proposal. The other level of transparency is how they got to that decision and how they decided to sign that transaction. You have neither of those. You don't have either of those on Bitfinex, right? You don't know how decisions are made. You don't know who owns the company. If you participate in that company and you buy shares, you don't know what you're going to do with your money. So I totally agree with you that we're a ways off from getting a governance that's totally transparent, and there's no governance theater as people usually criticize Maker because there's like big whales, and it's not perfect, but it's kind of on the path, on the way to getting to a fully decentralized and more well distributed a supply of tokens.
So Balancer recently did a pretty successful seed raise from Placeholder and another VC firm that I can't remember the name of. Accomplice. Yeah. So congratulations on that. What is the long-term business model for Balancer? How do you guys plan on monetizing?
Sure. So that kind of circles back to the point of the token that I just mentioned. So the idea of the protocol is to keep evolving over time. We know that there's going to be new things happening like ETH 2.0, scalability, layer 2, optimistic rollup. So many things are going to happen very fast, and we believe that the protocol will die off if it doesn't keep evolving. So we need a sustainable way to make that happen. We believe in decentralization, so we want those decisions and that kind of evolution of the protocol to be done eventually by token holders. And that's the only way kind of we found to make this decentralized, using a token for people to be kind of staked and have their interests in, kind of aligned with the project. So the idea is that we're gonna introduce a token, Balancer token, in version 2, which will accrue value through like the collection of protocol level fees. So now we have 0 protocol fees, like all the fees that are paid by traders stay within the liquidity pool for liquidity providers. We're going to get a very small fraction of that, and that will be used to accrue value to the token. And that's pretty much the idea. And I can go into more detail if you want to know like some more details I can talk about.
Yeah, so we're going into a little bit more about where those fees come from. Does that come from the order routing, or is it part of every single Balancer pool ever? Where do those fees come from?
So we've discussed a lot of the different options, and we want to be as kind of closer, like the closest possible to you only pay if you get some. So we want to be kind of a performance. Yeah, we want to introduce a performance fee. And actually, we had decided before Uniswap V2 came, like kind of disclosed how they're doing that, and it's a very similar way. So you get a cut of the trading fees of any balancer pool. So very, very simple. Like you make $10, I take one as a protocol fee. And if you don't make any trades, any money, you don't pay anything. Yeah.
So do you think that impacts the permissionlessness or censorship resistance of Balancer if you are implanting a fee model into the protocol? And I believe it's not an opt-out, you're not able to opt out of it. Do you think that impacts the nature of the protocol at all?
I don't think so. It's still going to be totally permissionless. You can create like a pool with 2 shit tokens that no one cares about. Balancer will still get a fraction of those shit tokens that no one cares about. But we cannot kind of intervene or change anything about that pool. The only thing is that whatever you people trade on your pool, we get a small fraction of that. Yeah, we might never actually use those tokens. So yeah.
These will also be governance tokens, right?
So those will be some like through some mechanism where we're still thinking about the details, but those will be kind of auctioned to accrue value to the balancer token that will be the governance token, if that makes sense.
Wait, so sorry, the governance token and then the fee model token are separate tokens, or they're the same token?
No, it's separate. So the fees are going to be paid in like in the tokens that are being traded. So if you have an ETH DAI pool, then if someone is paying like it's trading ETH for DAI, there's like the trading fee, which is, let's say, 0.5%. And out of those 0.5%, we take, let's say, 10% of that. So we get the fee in the tokens that are being traded. So we get the fee in ETH, in DAI, in 0x, or whatever. All those tokens will kind of like go to the protocol, and somehow it's going to be a magical, and we're talking about, like, we have some details already, but it's not set in stone. Those tokens will be auctioned and kind of accrue value to the protocol token, which is the governance token, balancer token.
I see. Okay, so the value does go to the balancer token. So the balancer has its own token that's kind of like MKR, right? It's pretty similar to the MKR model.
In a way, yeah. In a way, it's very similar. Yeah, we're still thinking of is it going to be a buy and burn mechanism or something else, but definitely very similar. Yeah.
Would it be fair to
say? So
the
important thing is that nothing goes to our company. So our company will not have any revenues. Like there's no admin or multi-sig where the fees are kind of, and that's actually different from Uniswap. So Uniswap has a kind of an owner address where if activated, the fee goes to that address. Right. Sorry, Christian, I interrupted you.
No worries. I was gonna say, would it be fair to say that Balancer is kind of like a hybrid between Uniswap and MakerDAO governance?
So far, Uniswap has 0 governance, and that's one of the reasons why it's so popular and so beloved, and I like it so much, for example. But I think, like, yeah, in the sense that Maker is very complex, and there's a lot of parameters that if the governance doesn't get right or set right, they're kind of penalized by whatever like happens to the protocol. We don't think that's going to be our case. So token holders are not going to be penalized because the parameters that they will decide to set are very kind of limited in the impact that they might have. For example, what percentage of the trading fees is going to be capped by the protocol? If we go too high, then people will fork Balancer, and we're going to kind of die off. So we have an interest of not charging too much. But if we charge too little, we don't have enough money to kind of maintain and sustain the project, the protocol. Does that make sense?
So I guess what prevents the DAO or the governance system from becoming too rent seeking? Like, it sounds like obviously charging too much is something that, that could be negative rent seeking, could cause someone to fork it away. What would kind of prevent that from happening?
I think the rational, if rational token holders know that if we charge too much, people will fork the protocol away, and that probably will be the more successful, the higher the fee we propose. So if we say we're going to take half of the trading fees, someone is going to, like, anyone can fork the project, right? But if we charge 50%, that fork will probably be very successful because people will be pissed off, like they're getting half of our trading fee, so I'll go to this other. But if we're charging like, so Uniswap charges a sixth, so 16%.
0.3%.
Yeah, 0.05 from 0.3. Yeah, so that's a sixth, so 16%. We actually are thinking of charging less than that, but there's no like kind of set, it's not set in stone. But if we let's say we charge only 1%, like people fork it off, like why would I move on to that fork? Like I know those guys are legit. They've been working on that for years, and there's like already some moat around it, because liquidity is moat, right? If you fork the project, you need to build integrations and liquidity in order for traders to find your liquidity useful, because otherwise the slippage will be too high. So there's like this all those aspects that have to be taken into consideration for the governance to set the fee. So it would be dumb to say I'll take 50% as the percentage that goes to the protocol.
Well, so before we wrap it up, I do kind of want to talk a little bit about what has been, the kind of recent hacks that have happened in DeFi around kind of like Bitcoin synthetics or Bitcoin tokens. I know that you guys are using BTC++. Can you talk about why you made that choice and what you guys have kind of like learned from the recent exploits that have happened in other protocols?
Sure. So actually, BTC++ uses Balancer as a primitive. So every BTC++ is actually the share of a Balancer pool that's composed of the 4 underlying flavors of Bitcoin. One of those is I am Bitcoin, right? The one that has the 70, the reentrancy attack factor. So like what I think about those attacks is that like there's 2 ways, like going more technical here in the weeds, but there's 2 easy ways to avoid reentrancy attacks, and those are like not new, right? So any auditor would have seen that happening. One of them is have a mutex. The other one is just applying standard kind of best practices, which is checks, effects, and interactions. So if you decrease the balance of the guy that's removing tokens, and then you let them execute any random external token, there's no way they can do reentrancy attacks. And that's actually, unfortunately, a problem with Uniswap. They didn't follow that. So as far as I know, I could be mistaken, but if they had updated the balance of the attacker before they could reentry that function, then that wouldn't have happened, right? So I do believe that we'll still be seeing some of those attacks in DeFi, because like there's so many moving pieces. Like the 777 standard is very good, but if you don't use it correctly, you might have such problems. Like if you copy someone else's code without understanding it, then you might have some problems. So yeah, I think that's kind of the lesson for us. And yeah, we just getting like the chance to say that we've been very careful with security. We have like had some very good programmers, coders look at our code. We did an audit with Tray of Bits, which is very, very good. Like they're awesome. We're having a second audit with Consensus Diligence. We have a very to me a nice bug bounty live, and we're still saying for people like not to put a lot of money, because this is a very new project. Like we just launched by 31st of March, so 20 days. But we are being very careful on the security side, yeah. And of course, we applied all those best practices, like having a mutex and having like checks, effects, interactions, best practices, yeah.
Well, I'm certainly optimistic about the future of Balancer in its growth on Ethereum. If people want to find out more about Balancer, where should they go?
We have a very active Twitter channel. So the main communication or announcements is done there. We have our Discord channel where people can ask questions, technical ones, or kind of discuss with our community members. We also have a Medium, like with some interesting articles people could go to, but all of those links are on our website, balancer.finance. So if you go there, you can find like a link to our Twitter, to our Medium, to our Discord channel. So that's the place to go.
If you guys are also looking for more information about Balancer, I would highly recommend the article that I wrote in Bankless not too long ago about how Realty is looking at different ways to incorporate Balancer so we can get a single token out of our many individual real estate tokens, so that can be the collateral for DeFi. I thought that was a good article. And
Definitely.
I'm also
Very
in
good.
the Balancer Discord, so you guys can find me there as well. Fernando, is there any last messages for our listeners? Who do you want to hear from?
Yeah, I think, so we are very, very happy with the feedback we got. We want you to build on Balancer. We're very open to answering technical questions. Our CTO, Mike McDonald, is always welcoming questions and interactions on our Discord channel. So please do not hesitate to come and ask questions and build on Balancer. We want to be a primitive that's used and useful for DeFi.
Awesome. Thanks, Fernando.
Thanks a lot,
Make
guys.
sure to follow the show, POV Crypto Pod.
And you can follow me at Trustless State, both on Twitter and on Bankless. Christian.
Yep. I guess I should have said this earlier, but at CK Snarks, y'all know. Thanks, Fernando, for joining. Thanks for everyone who tuned into the stream.
All right. Thanks, Fernando.
Thanks for having me. Bye-bye, guys.